You are taking a huge risk of loss of business if your business is underinsured, and here's how to know if your business is underinsured in the first place. So let's get right into it. What happens if your business is underinsured and how to avoid the cost? What you're going to learn in this video is the consequences of being underinsured, why coverage gaps happen in the first place, coverage gaps equal being underinsured, and pro tips to avoid underinsurance in the first place. And make sure that you stick around till the end because, again, I will be going over a surprising tip at the end of this video that's going to help you avoid losing tens of thousands of dollars in the case of a disaster. So here are some of the direct consequences of being underinsured. One is financial losses, legal consequences, operational disruptions, reputational damage, missed opportunities, and increased stress. Let's go over some of these in a little bit more detail. So in terms of financial losses, just looking at my notes over here, if a disaster or unexpected event occurs, underinsurance means the payout may not fully cover the costs, leaving the business to cover the remaining amount. Big problem. And then a severe financial strain from out-of-pocket expenses can push a business towards insolvency. And all insolvency means is just not being able to repay your debt if you start to incur too much of it. Diving in deeper into legal consequences. Without having enough liability insurance, your business might face a lawsuit for damages or injuries. This could lead to really high-cost legal fees and settlements. And then depending on the industry and region, underinsurance may violate legal requirements. And that's right, yeah, there are certain regions and certain industries that require a certain amount of coverage if you want to operate in them on a legal basis. Going into operational disruptions. Insufficient business interruption insurance can result in lost income during recovery periods after disasters or incidents. You're going to want to get business interruption insurance. If you ever, God forbid, have a fire in your business, you're going to want to be able to have your lost revenue covered for that period of time while you're rebuilding. That way, you won't have to take on monthly debt in order to cover monthly costs that you may incur during that lost period of revenue time period. Another problem in operational disruptions is having a lack of equipment coverage. If your very expensive equipment in your business gets damaged in any way, you want to make sure that it's covered. A lot of business owners see that as an extra coverage, but it's really not, because you want to be protecting something that's extremely vital to your business. And I'm going to skip diving into the reputational damage portion of this, but in terms of missed opportunities, dealing with financial stress or financial strain from these kinds of losses may make your budget move towards those types of things and towards recovery rather than being able to focus on expansion. If you have the correct coverages, those coverages can cover your losses, your damages, while you can continue focus on expansion if that's what you're interested in doing. You don't want these types of issues to interrupt the flow of your business. So here's a real life example of having an underinsured business. So let's say you had a restaurant. It went on fire, God forbid, and you had $300,000 in damages, but you were only covered for $150,000 in equipment. Well, now the other $150,000 you're going to have to pay out of pocket. Where if you were expanding and buying new equipment, you could have replaced the kind of coverages that you had in your policy and you would have been covered fine. And a lot of the time, increasing coverages like that, it won't really cost that much extra in premium. So it's just a no-brainer to do it. Make sure that when you're getting new equipment, you raise the coverages for them. And if you don't have any equipment coverage, you have to make sure that you get. Here's a little bit more of a deep dive as to why coverage gaps happen in the first place. Some of the common causes are adding new locations or equipment without updating policies, like we just mentioned, misclassified risks leading to inadequate coverage. So here's a really good example of this. A lot of brokers do this in order to save restaurants costs. For instance, if there's a restaurant that offers liquor, a broker, in order to make the premium much cheaper, will just give the business general liability coverage for a regular restaurant that does not have liquor sales, and that's going to make the premium cheaper, but it may result in you not having your claims paid out if you ever have any. That's a big problem. You want to make sure that that's not happening and that you're properly classified. And then the third problem is relying on outdated valuations for property or assets. And again, that's something we already went over. And here's just an example of what could happen as a business expands. So the number of your employees continues to grow, your revenue continues to grow, but your coverage stays the same. So you see in the beginning, you were covered over here fine, based on what you started with. And then if you or your broker, and this should be your broker's job, but you still should check your broker once in a while. If you or your broker do not check your policies over time and update them based on the new level of risks that you have, the higher revenue and the larger number of employees, well, you're getting more and more exposed. And that becomes a big, big problem. Because say you had a very, very large claim in a situation where you grew and you never updated your coverages, well, that could mean literally the end of your business. So, and I don't want to scare you guys, but this is all in the realm of possibility. So that's why I'm making this video. And if you like this video so far, I want to introduce myself. My name is Alex and I run CommercialInsurance-io. If you guys need any help and would like to go over any of your policies and want to see if you're not underinsured and you're maybe not super happy with your broker, then give us a holler. Visit quotes.commercialinsurance.io/total risk protocol and book a call with us. Let's see what we can do. Okay, let's move on. So here are some steps to avoid underinsurance. 1. Conduct regular coverage reviews. Schedule an insurance review annually or whenever your business experiences major changes. So if you're working with a broker, you want to make sure you tell them when there's a very big business change. You have to continuously work with them. You can't hide things from them, worrying that they're going to raise the prices on you or whatever. You have to keep them informed. Yes, there is a potential for your premiums to go up, but it doesn't always mean that you have to take every piece of advice that a broker gives you. It's just you want to make sure that you let a broker know or your broker know that you have these major changes and see what kind of recommendations they give you. 2 is you want to understand your policy limits and exclusions. Always check what's covered and what's excluded in the policy. And here's an example of this. A manufacturer that I worked with assumed that their equipment was fully insured, but the policy had a sub-limit for machinery damage when it came time to actually repairing the damaged machines. And just to be clear, this damage came from regular wear and tear. There was no signs that anything abnormal or irregular happened or some kind of mistake, and that was part of the reason why they were not covered. So you have to make sure that you're looking into those types of nuances too. You may be covered for certain things, but there's a criteria for when you can be covered for them. You have to make sure you look out for those nuances as well. And the third and the last thing that you want to do is work with a proactive broker. If it has not been clear so far throughout this video, the best thing that you can do to avoid underinsurance in the first place is to work with a proactive broker that can tell you your coverage gaps ahead of time, and that'll avoid all of the problems. Obviously, you must be receptive to the suggestions of the broker, but it's your decision at the end of the day to discern whether you need an increased coverage, maybe you need an additional coverage or not. But at least having a proactive broker will give you the information or empower you with the information that you need to make that decision. So here's some of the differences between a reactive and a proactive broker. In terms of interaction with a client, a reactive broker waits for a client to initiate contact. A proactive broker regularly checks in, offers updates, and anticipates needs. In a program like the one that we have in Total Risk Protocol, we make it a point to meet with our clients every single year right before their renewal to go over everything that's changed in their business. In terms of risk management, a reactive broker would address issues after a claim or incident occurs. You don't want that. You want a proactive broker who's going to identify potential issues beforehand and suggest proactive measures like I just mentioned. Again, something I've mentioned multiple times in this video is coverage updates. And this is a two-party type of solution where the business owner, you, has to communicate with the broker and make sure you tell them what big updates are happening in your business so that they can be proactive about it and give you any kind of recommendations that they have for changing your coverages going forward. And you could pause this video to look at the rest of the examples that I have down here. And the bonus underinsurance tip that I have for you here is inflation trap. Not a lot of business owners think about this, but here's what happens. This bar graph shows the property values steadily increasing year over year for a property. Coverage limits stay the same, and this happens with the majority of real estate owners that come to us 99% of the time when they own some kind of real property, like a building or a home. It's underinsured. Why? Because the value of their property goes up every single year, but the value of their coverage does not. And over a period of 5, 10, 20 years, these property values can go up so much they could literally double, triple, especially if you're in a very high populated area like New York or California. And the last tip that I want to leave for you guys is bundle your policies whenever you can. A bundled policy simplifies your coverages, and it also saves you money with potential discounts that the carriers offer. A good example of this is a business owner's policy, which combines a few different things like general liability, real property coverage if you own the building that you operate out of, and also your business's personal property, think equipment. So let's go over a summary of everything we just went over in this video so far. To avoid underinsurance, what you need to do is review your coverage regularly, understand your policy limits and exclusions, and the most important piece of this, to work with a proactive broker who has your back. Again, that would be us. So if you're interested in any of the things that I was saying and you want to implement them in your business, then feel free to book a call with us at quotes.commercialinsurance.io/total risk protocol, and we'll see how we can help you out. Thanks for watching.